This is Mark Beshard, Managing Editor of Moonstone Publications. Today I'm speaking to Blessing Utete, the Managing Executive of Old Mutual Corporate Consultants, about the proposed two-part retirement legislation.
First question was whether the draft legislation is in line with what the industry expected.
Yes, Mark. So I think generally the draft is as expected by industry, and I think the reason is, this draft legislation is, from an industry perspective, has really been about resolving the preservation challenge that we've had in the retirement landscape. We have had a situation where members have accessed their funds and utilized them and at every change of a job. And that's meant that there's been quite a lot of leakage in the system, which has meant that members have just not had a decent outcome at retirement. So industry expected that part of this change will solve the preservation issue that we've got.
The one issue that the industry, I think, might be unhappy with, though, is the implementation date, which Treasury itself seems to think might be a bit optimistic.
Yes, Mark, I think definitely industry is going to probably push back on the implementation date because I think it's not realistic because of the complexity and the changes that need to be made from an administration perspective and the systems themselves. It's not realistic that we could make this happen on the 1st of March 2023. In fact, I think there is a view that it probably is going to take at least another 12 to 18 months for administrators to be ready to effectively implement these changes.
Something that hasn't found its way into the legislation, there was a lot of calls for this, was for members to be able to seed the savings pot, which is the pot from which people can make withdrawals without conditions attached. Treasury seems to be quite firm on this now, that that's not going to be allowed. Perhaps briefly just provide what the thinking is there.
At the height of the COVID pandemic, we had lots of these calls around access towards retirement funding. And I think at that time, one would have thought that because of the financial distress, there was a need for some access of past savings, and hence the first paper spoke about you're up to 10% subject to a maximum of 25,000 Rand being seeded. But I think when you've looked at all the various elements, which include the fact that there's a risk of members drawing down a big part of their retirement savings and then leaving them even more vulnerable when they retire, because I think there's the figures quoted in the paper talk about the average sort of fund credit being 37,000 Rand at July 2020. So it's that number could be significantly dented if people were allowed to have some access at this point in time. I think also retirement funds are about investment returns. Compound interest is key, and taking some money out of the system would actually impact that investment return that people would get. And then also the financial viability of specific funds. The fund types that are not designed to accommodate these annual withdrawals, those had to be taken into account. And then lastly, the issue of liquidity. The fact that one could have had a negative shock on asset prices if we allowed this 1/3 to be accessed immediately. So these are some of the factors that National Treasury had to weigh up to actually get to the point where I guess we are now, that there is no seeding of past savings into the future structure.
Just a high-level view of the legislation. Which funds are included and which retirement funds are excluded from the system?
So the funds that are included are all funds that are under the Pension Funds Act. So that is your pension, provident, retirement annuity and preservation funds. What is silent at the moment is around defined benefit funds. There's no commentary around what happens to those types of funds. In addition, there isn't any information around public sector funds. So at this stage, we assume that public sector funds are excluded from this piece of legislation that's being proposed.
Explained to me by someone in retirement industry that there's a simple way of understanding two pots, is that it's basically allowing people to take their lump sum, their 1/3 cash lump sum, in advance before they retire. So Could you just explain what are the implications of taking, your third lump sum, and then when you get to retirement, how do these work together? What are the implications?
So your savings pot is what you're going to be allowed to take as a cash lump sum when you get to retirement as well. So if you go and you take out money from the savings pot and you access that annually, at the time of retirement, you've got nothing sitting in your savings pot, then effectively you won't have any cash lump sum that you'll be able to draw at retirement. You'll only start getting a pension which comes from your retirement pot. And so that's something that people should think about in terms of putting money into that savings pot, because that's actually the pot that you're going to be entitled to get as 1/3. And remember that there is that lump sum tax table that is used for retirement savings, which is that you can get up to R500,000 rand tax free in at retirement if you take up to 1/3 as cash. So there is that change, that amount is the cumulative amount that you can access at retirement as a cash lump sum.
Also, let's just clarify, when we're talking about withdrawing contributions from the savings pot, that withdrawal, that includes the employee's contribution and the employer's contribution, plus any growth on those combined contributions. That's what you can take out of the savings pot.
Correct, Mark. Yeah, you can take your full contributions that you've made, employer and employee. You can take up to 1/3 of that. So, as an example, if your total contribution to retirement is 10%, then 1/3 of that, 3%, is what you can take in the savings pot, and you can access that. The other 7% has to go into the retirement pot for retirement savings.
The system's called two pots, but it's a bit more complicated than that, because we've got the two new pots, one for savings, one for retirement. We've got a vested pot, but there's a bit of complications around provident funds as well. Can you explain what the situation is there?
Yes, Mark. So I think effectively some have quoted that this is maybe three pots, because it's got your savings pot, your retirement pot, and your vested pot. Your vested pot meaning it's the old money that you had up to the date that this legislation is passed. But if you are a member that is over 55 years at the 1st of March 2021, and you were still contributing to your provident fund, then those people will be allowed to continue to contribute into their vested pot going forward. So those are the category of people that will be allowed to continue to do that. Everyone else will have these three pots that you've described.
They also need to just clarify something around transfers between pots. My understanding is you cannot transfer money out of the retirement pot into the savings pot. Once you've put money into that retirement pot, it has to stay there, but you can transfer money from your savings pot to top up your retirement pot.
Yes, Marcus. So the retirement pot money stays the retirement pot money, and you can't move that into the savings pot so it becomes accessible. It has to stay in there, and these pots have to follow their origin when they move to the new fund. So savings pot goes into savings pot, retirement pot goes into the retirement pot. You can top up your retirement pot by your savings pot. So you can decide to say, I want some of my savings pot to go into my retirement pot. So yes, it generally follows the pot design that you start off with if you transfer.
And something else we need to nail down regarding the retirement pot, which is different to the current system, is that you cannot access your savings in that retirement pot. Even if you resign, the retirement pot now is untouchable until retirement. That's how it is now. That's how it will be, sorry.
That's how it will be. And I think that actually is the monumental shift that we're going to see in the industry, that you will no longer be able to access that retirement pot. It will only be accessed when you get to retirement. And again, it goes back to my earlier comment that it solves this issue of people not preserving and the leakage that we've had and hence the poor retirement outcomes. So that really is the key change in terms of the shift in providing better retirement outcomes.
So to clarify, the money in the retirement pot must be annuitized.
Yes, Mark, that's correct. All the money that's going to go into the retirement pot will need to be used to purchase an annuity. The minimum amount that can be used to purchase an annuity has to be at least 165,000 Rand. Any amounts less than that in the retirement pot can be withdrawn as a lump sum.
There's a lot of talk leading up to this legislation about how we would get two pots to work with the tax system, current tax benefits for retirement contributions. And my understanding is that those existing tax breaks for deductions remain in place, irrespective of whether you contribute to the savings pot or the retirement pot.
Correct. The total deduction allowed, which is your 27.5% up to 350,000 Rand per annum, is still what will be allowed as a deduction for retirement saving contributions. So I guess it's still saying, we encouraged and we're given the tax breaks to save for retirement. And that's not going to be reduced by the fact that people are going to still have some access going forward.
Now, the change, the other big change, I suppose, with the system with withdrawals is that to be able to withdraw the money from the savings pot, members don't have to resign, quit their jobs any longer. They will be allowed to make one withdrawal a year, minimum 2,000 Rand. But there's a bit of a catch. It's not an entirely consequence-free withdrawal. There could be tax implications for that withdrawal.
Yes, correct. So there is some different tax implications now applied to this access amount that you can take from the savings pot. If you access money from the savings pot, that once a year, you'll access it and pay tax at your marginal tax rate. So if you were paying tax at sort of 45%, it's your marginal tax rate. That's the amount that you'll pay tax on the amount that you access. And then only at retirement do you get the sort of lump sum tax break that's available.
It seems that Treasury's thinking around this is to discourage people from withdrawing unless they really have to. So, for example, people who are already earning a salary and only want to make a withdrawal, for example, to go on holiday or renovate their home, will have to think about the potential implications of withdrawing a sizable amount of money, which will be added to their taxable income. Whereas people who are perhaps been out of a job for a while, haven't been earning, and they make a withdrawal, they could potentially escape the tax consequences.
Yes, Mark, and I think that's the balancing that needed to be done. To the extent that if someone needs to think twice about taking this money if you're still employed, and it almost becomes this is money of last resort. Ideally, people should have emergency savings outside of the retirement arrangements. But where you don't, and this is the only money that you've got access to when you're in financial distress, it does give that ability to take money. And I guess one of the elements is, had the old tax tables for withdrawal stayed in this environment, it could have meant that certain people that are at higher tax brackets than the maximum 36% that's paid on resignation at the moment, they could have benefited from accessing at lower tax regimes. But it actually almost does deals with each tax event. If you're not earning an income, there's potentially no tax. If you are earning an income, then you have to think twice, because there is a disincentive in terms of the amount of tax you actually pay.
Right. Something that I think is very important to clarify, because I've seen conflicting reports on this when it comes to the vested pot, the pot that will contain people's accumulated savings. That's obviously for members who belong to funds by implementation date, will have accumulated some savings. People's savings in the vested pot, they can't they will be able to access those savings, but they will have to resign. Is that correct? You can get to your vested savings under the existing conditions, which is resignation from your job. Is that
Yes,
correct?
that's correct. So your vested benefits. So anything you have up to, if we just for argument's sake use the 1st of March 2023, if you have any money up to that date, you can access it on resignation, as you've always done in the past. And I think it's important to that's how we probably need to educate in terms of behavior, because with all these sort of announcements, there could be panic and people think I'm losing my rights going forward. That right for the old money is not being lost. This is only for the new regulations are around new money after that effective date. So if you resign after the 1st of March 2023, you can still access those benefits, and you'll access them at the withdrawal tax tables that are there.
Okay. Let's just talk about some other issues that arise from this. How will divorce orders apply to a member's retirement interest when it comes to dealing with savings in the three pots? Let's just say three pots for the sake of arguments and not get too complicated.
So we're still going to get a lot more detail, but I think effectively the divorce order would ideally apply to both pots proportionately. So whatever is sitting as the total retirement interest, savings pot, retirement pot, vested pot, that becomes part of the retirement interest that can be applied in for a divorce order. So I guess there's other complexities that one thinks about. We had these pension-backed loans that are there, and pension-backed loans, one has to now think that they potentially only now apply to the retirement pot, because someone can actually access their savings pot at any time, and therefore that security is no longer there. So those are some of the sort of practicalities that retirement fund administrators and trustees will have to think about. How to apply some of these things. But from a divorce order perspective, it's proportionately across all pots.
Okay. And on immigration, people will be able to access their savings in the pots, all three
yes,
pots?
full withdrawal is allowed on immigration.
The Treasury document said that it's optional to decide whether members want to allocate to the savings pot, but it doesn't make it clear to me, when members must or can exercise this option. Is it a choice that you get once a year? Was this something that funds will be allowed to decide, or are we going to have to wait for legislation to tell us when?
Yeah, I think these are the elements that will need trustees to decide how each fund is going to deal with two pot. Effectively, we're seeing an introduction of more options and flexibility for members. So I think the draft says up to 1/3. So there's that choice of how much a person wants to contribute, from 0 to 33% of their total contributions. And so the fund rules will need to determine that, and determine how often, almost in a similar fashion to how contribution rates are determined in some funds on an annual basis. You can increase your contributions on an annual basis, and one would think that those types of choices, like contribution levels or investment choices, those choices will be governed around the fund rules that are applicable for respective funds. Sorry, Mark, I think that the only other thing I can just think about is that funds will also have to think about what are the defaults. So does your default now become a third is the default? The legislation says up to 1/3, but trustees may say, if someone doesn't elect, what happens to that individual's contribution? Does it mean that individual's contribution is simply split 1/3, 2/3 as a default? So those are some of the things that trustees will have to think about.
Yeah, I just thinking about the level of flexibility and choice that can be given, because to say, as we've spoken about before, members can transfer, they can top up their retirement pot, but how much admin is going to be involved if you give members the ability to decide that, every month, how often can they do it? It could be quite onerous for trustees to have to deal, and funds to have to deal with the admin involved in all this.
Correct. I think it could be it could be quite complex in terms of the admin and the record keeping around how these choices are dealt with and maintained ongoing. And I guess hence this talks to the issue of implementation date. The level of complexity is determined by the number of choices and flexibility that actually is given, and what retirement funds actually then decide. And that actually would then, determine how quickly or how long it's going to take us to actually get these things implemented.
Just further to that, what do you think are going to be some of the big challenges for trustees and fund administrators in implementing this system?
Yeah, so I think we've briefly highlighted around the complexity, and I think with complexity comes cost. So trustees will have to think about how much sort of cost increase and who bears the cost of these changes to the access that's available. I guess a school of thought says the individual that accesses the money is the one that should pay the transaction fees around that. And so one has to think about trustees in an environment where they structure their fees accordingly, and the administrator is making up for the complexity that's being there. I think funds are obviously not created for this annual access. We've never had it before. So one could envisage an environment where we see increased volumes on these transactions. So from an administrator perspective, it's dealing with those volumes. The systems in terms of reporting and accounting for the various pots and where, as we've spoken about, complexity around transfers and maintaining those records, administrators need to think about. Updating member benefit statements, the contribution allocation decisions, dealing with the tax treatment practically. I think there's certain elements of the administrator having all the information. And in some cases, because in the past we only had to transact where there's a resignation that's triggered from an employer, there was that interaction with the employer. We probably are moving into a world where this type of access is between the member and the fund directly, depending on the rules that are in place. So I think there's going to be a lot more, definition around practically what is going to happen from an administrative perspective. I think also underpinning that, the administrators are chasing efficiencies, so they need to be, working smart to actually deliver the best service that they can. But there are all these complexities that one has to think about from an administrator perspective. I think from a trustee perspective, one has to think about, investment strategies. What does it mean for the investment strategies that trustees have? Do you have, or do you allow investment strategies that are different between the savings pot and the retirement pot? So there's some of the things that one can think about from a trustee perspective. And I've already mentioned the issue of what defaults do they put in place to cater for those people that don't elect in this environment. Yeah, so in a nutshell, I think from an administrator and a trustee perspective, those are some of the thoughts that one would have to think about.
Yeah, I don't know how trustees, particularly administrators, are going to negotiate this, because we've got the draft legislation out for comment, and do they go ahead now and start changing their systems and assume that what we see now is what's going to be the final product, or should they wait and think, well, maybe there are going to be some changes, hoping to get there by 1st of March next year? So it's a bit difficult to know what the right thing to do is at this point.
Look, I think, Mark, there's already been commentary that's gone to National Treasury about the dates. Yes, the commentary is we probably still have another month, to the end of this month to give full commentary. But I'm aware that some industry stakeholders have already alerted National Treasury to the date issue. And so I think administrators would probably wait until there's more clarity on these things before they start building or developing their systems. I think we've got a rough framework in which to work with. So, one would know what are some of the things that need to happen, but it's not everything that is needed. And things could change with the commentary that goes in now in this next month.
Yeah. I think you spoke about this just a little bit before about investment strategy implications. We're now heading into a system where withdrawals are going to be kind of built in. We've already got quite a high level of withdrawals with people resigning and withdrawing. Now we've got a savings pot withdrawal. Does the system, do you think, is going to materially affect how to think about investment strategies? Or is it just formalize something that we've already got? I mean, do you think we're going to have a lot more withdrawals being made from retirement funds?
Yeah, look, I think, we now talk about behavior in the South African market, and I think one would say we're not big savers. And so potentially any option to have access does mean that people are going to utilize this. I guess also the other element is, as soon as you say you can only access once a year, does that actually not mean that members will take that opportunity to access once a year? So I think we are going to get an increase in transactions and members wanting to get this access. The important thing is around education and what we do as an industry. Really educate people around the tax implications. This should really be emergencies, and this should really be money that is used when you're in financial distress. I think trustees and the industry will need to educate their members around this to manage the frequency of it. One would say, if we are in the world where trustees perceive this to be all retirement money, then investment strategies pretty much stay as they have been. They can cater for the access that happens. But at an individual level, members may have flexibility to say, I'd rather be in a low volatile fixed income type investment structure because I'm going to access the savings pot in the next year. So I think there will be, from a fund perspective, there may be a general view that we consider it all as retirement money and people are saving for the long term, and investment strategies should be along the long term view. But maybe at a member level, there could be some level of choice that is provided to choose different investment strategies for the different pots.
So in its explanatory memorandum, National Treasury provided an example of the options for someone who belongs to a provident fund at the time of the implementation of the two-pot system. And in this example, they've got the person has 25,000 in a savings pot, 100,000 in the retirement pot, 250,000 in the vested pot. And part of this example shows what happens if the member resigns, but then joins another company. What they say is that the 1/3 savings pot and the 2/3 retirement pot can either stay in the current fund or be transferred to another fund, which has a savings pot and a retirement pot, potentially at their new employer. The 1/3 savings pot is still accessible at any time. And then they give the following options for the vested pot. The person can withdraw 250,000, although this amount is subject to tax at the withdrawal tax table, or transfer the 250,000 to another vested pot within a provident preservation fund. And this person's obviously eligible for the once-off withdrawal before retirement. And all the person can transfer the 250,000 to the retirement pot to consolidate their retirement interest. So the question that's been raised is then, does this mean that a provident fund member can't transfer his or her savings to in the vested pot to a vested pot in another retirement fund? Do they forfeit this when changing jobs?
Yeah, Mark. So I think you've described quite nicely what the options are, and that's what the example tries to do in the memorandum. But I think if you then look at the actual tax, the Draft Tax Act conditions itself, it does indicate that a vested pot can be moved into a vested pot of another employer. So I think basically the transfers from the various pots can follow those pots into other retirement funds, be it as registered. So I don't think people will lose that vested amount if they transfer it into a new employer's retirement pot.
Yeah, and
It just has to follow the design. It just has to follow the design of the pot where it's coming from. Savings into savings, retirement into retirement, and vested into vested.
and that applies across all retirement funds.
That's the current reading we have of the draft act at the moment. Yeah.
I've been speaking to Blessing Utete, the Managing Executive of Old Mutual Corporate Consultants. I'm Mark Beshard from Moonstone Information Refinery.